Hey everybody, welcome back to the channel. Today's Wednesday where I go over some sort of option subject, right? But I came to realize I actually talk a lot more about options than I think I do. So if you missed it, this past Saturday, I run a simulated portfolio for a retiree, right? I run a portfolio that started out with $250,000, and I've been trying to sell covered calls to generate income and see how that would work in retirement for myself. Because I anticipate having probably around $250,000 when I retire, and I'm going to have to use that money to generate income. So, for the past 12 months, I've been running a covered call strategy on that series that's called Retire with Less. Um, and I'm starting to transition that into the wheel strategy as well. So that video series compares my strategies versus just owning QYLD, right? So if you missed it, I'll link it down below. I'll link it up top. Check it out. I think it's really powerful for those people like myself who started investing late, and will probably not have a very large nest egg. So knowing that you can generate income from a smaller portfolio, and maybe it's enough money for you to live on, but maybe you have a little side hustle or some other forms of income that can supplement that. It's really great, really eye-opening to know, right? Because most people think you need millions of dollars to retire, and that's typically not true. So would love for you to check those out. Leave me a comment down below if you like, share, and if you like the series. Comment down below, share, subscribe, all that good stuff, and we'll just get into it today. So today I am looking at pretty much all my my personal covered call positions, and I'm going to talk about leaps, buying leaps, not PMCCs, just buying leaps. We'll talk about that toward the end, but I'll just race through all my positions right now, and we'll talk about them because I didn't do a whole lot this week. So if you recall, I had the Jets wheel. I ended up closing that wheel out on Friday the 23rd. I closed that put out for 13 cents. And I thought I'd come back Monday and sell another put. Well, the stock went up on Monday and I just did not do it. I'm going to essentially call this position closed unless Jets comes back with some decent premium. I probably will not touch this one again. Because if you look back on March, I was getting 60 cents and then I got 50 cents for the covered call. And then, it dropped down to 33 cents. And that was about, roughly what I would have got this week as well, actually a little lower. So I decided against it. So for now, I'm going to say the Jets wheel is on hold. We made 2.83% in, a month, which was mostly from premium received. So there's no complaints from me on this position. Next up is my Palantir position. I did sell a covered call on April 21st for expiration date of this Friday for 28 cents. Now Palantir is selling for currently 23.88. So it is in danger of being called away, and I will just let it be called away. If it does get called away, we'll be close to 6% on that position in about a month. So again, no complaints there. My Oxy wheel looks like it's possibly, because on the 21st, I sold a covered call, expires this Friday on a 25 strike. It's just above that strike right now. I collected 41 cents, and I will let this position go as well. And if we do, we will make about 4.81% roughly on a few week hold. So again, no complaints there. Now my Rocket Mortgage one, I didn't check earnings when I sold this covered call. I wish I would have. But then again, You know, I'm not married to any stock. I'm only married to my wife, thankfully. And I sold a covered call on the 21st that expires on May 7th. I think they have earnings on the 5th. So if Rocket Mortgage decides to creep up above $23, we will be closing this position out. And again, not a big deal. You know, you're talking maybe roughly 3 month hold, and we'd make roughly 28% on that position. So again, no complaints there. Tilray, this is one that I've been trying to get into in a sense. Not really. I'm kind of halfway trying to get into it. But I've been selling the $16 weekly cash secured puts on it. And I've been just collecting premium. It has not challenged that $16 strike just yet. Looks like this week this one's going to expire worthless as well, because it expires on Friday. We collected 28 cents on that. So overall, in the last 3 weeks, we've collected $91.90 to not own the stock of Tilray. And I'd be just fine doing that each and every week. Now we're going to talk about some leaps here. Now, leaps are long dated call options. Okay. Now, when I talk about them, usually in the context, I usually would talk about these in the context of a PMCC. If you haven't saw my PMCC video, I'll link that up top and down below as well. But you can also just buy leaps without selling a call against it. It's kind of a substitute to going long stock or owning stock in a sense. And I'm going to share with you a couple of positions that I bought leaps on this past month. And the first one is VTRS, or I don't know how you actually say that, but it's VTRS. It is the spinoff of Pfizer. Now, I used to own Pfizer way back, and I got out of Pfizer before they split off this company, which is Viatris and Milan combined. And I kept an eye on Viatris, and I thought, I can see myself getting into it because it's probably going to be a very stable cash flow type company, and at a value. It's at a real value. And when I went and bought these leaps, I bought them at a strike price of $12.50. I bought 2 of them, and I paid $3.40 for it. And I bought it a little early, right? I thought Viatris was going to just but have $13 as support, and I thought it would skyrocket up. It hasn't done that just yet, but we have earnings coming up, and earnings could possibly do that for us. But on April 6th, I bought 2 of them. I invested $680 into 2 Viatris leaps. We are currently down about 6%. Now, what I look at when I'm buying a leap, I really trade small, right? I don't like to make big bets in things. I like to trade small, trade often, take little bits of profit here and there and everywhere else. But when I look at a leap specifically, I look at companies that have had some bad news or some unneeded or unwanted, that's wrong words. They had some bad news. I want some companies that have gone down without any real reason, right? Their earnings are still good, sales are still good, all that, right? But for some reason, the market hates it. And that's where we're at with Viatris. So if you look here, I started looking at it when it made this dip down into the 13s, 14s, 13s. And I bought it. When did I buy it? Bought it April 6th. So right around here is when I bought it. There's 1383. And it's kind of gone down a little bit since then. And it's kind of leveled out right here. Now, this would have probably been a more ideal time to buy into it, and I might actually double down on this position. We have earnings coming up, And one thing I like to look at is why this happened, right? For Viatris, I don't know. There's really, it's just market sentiment. People think that Viatris is just going to be, it's obviously going to probably be a no growth company. But what I like about it is if you look down to their earnings, and we can look back 4 years, their earnings have been fairly steady, right? You're talking about revenue of almost $12 billion a year on this company, right? It's also not a small company, $16 billion market cap. So we're not talking about a micro cap. We're not talking about a small cap. Then I also look at the quarterly revenues, and we look at the revenues just increasing. So you do have earnings that have gone negative, but I think that was a part of the merger with Milan, Pfizer, and Viatris mixed together. So I think that's just a one-time thing. So that's pretty much what I look for in a leap, right? So long term, I'm bullish. I bought the leap, and we'll talk about how I can make money on the leap at the end. Just hang in there with me, and we'll talk about the second one here that I bought into. The second one that I bought into is ticker symbol TME. That's Tencent Music. It's a Chinese, Spotify kind of thing, music service. A lot of Chinese stocks recently have gone under a lot of pressure, and this one really caught my eye. Ticker symbol's TME. On April 15th, the stock was trading at 1782. I bought one leap at $5.76, which is, if you don't know, a leap consists of, or any option contract consists of 100 shares. So I paid $576 for this contract that controls 100 shares of stock. So right now, Tencent Music has gone up 1940 from when I bought it, and I am already in profit almost 20% on the leaps. Now, I'm going to show you, we'll talk about Tencent Music here, because you're going to see the same kind of chart that you see in Viatris. Something happened, and the stock got punished, right? You'll look at a lot of Chinese stocks, and they'll have a very similar looking chart. But again, $32 billion market cap. Revenues over the last 4 years, just growing and growing and growing. Last year, $29 billion in revenue, $4 billion in earnings. We look at it quarterly. Again, growing and growing and growing. 8.3 billion in revenue, 1.2 billion in earnings just in the last quarter. So why is it that this stock dropped? Well, you can look back and right around March 23rd, and you can go down and look at why Tencent went down, and it got caught up in a hedge fund blow up. So Credit Suisse and Archegos Capital had to sell a whole bunch of stock in a short squeeze or something like that, and it really put pressure on the stock, and it really dumped. But those are the opportunities that you really want to look for. Healthy company, strong earnings, growing revenue, and the stock dumped, right? And then you look at the next news article, Tencent to buy back $1 billion in stock. So this is still a healthy company. It was an anomaly of why the stock dropped. So that's why I went in and I got a leap. Probably should have bought a couple more. But how do you profit from a leap? Well, it's kind of like profiting from a stock, but in my opinion, it's better. And we'll look into an option chain to try to explain that. So here's the option chain of Tencent Music. Excuse me. And you'll see, here's the strikes right down the middle. Here's the calls. Here's the date, January 2023 is the date that I bought. And you'll see I'm at a 15 strike, and right now it's between $6.60 and $7. I paid $5.76 for it. But you're controlling 100 shares, right? for each leap you buy. So let's say to calculate your approximate return of what would happen if the stock were to go up, right? So I'm at a 15 strike. So let's say the stock goes up $5, okay, from here. And now you can minus $5 from the strike that you're at, and you can see approximately what your leap would be worth. So it doesn't work 100%, but it's an approximation. So if the stock went up $5, you can move up $5 on the option chain and see that the leap that you bought for, $6.80 is now worth around $10.20. Now, what if the stock went up $10? So you go up $10 on the option chain, and it's between $13 and $16. So if you were, for instance, to buy 100 shares outright, okay, of Tencent Music, you'd have to put up $1,939. But you could buy approximately 3 leaps with this strike and spend about the same amount of money. Okay, and you'll have control of almost 300 shares instead of the 100 by buying it outright. So if the share price were to go up $10 over here, that if it goes up $10, you'll make $10 times 100, you'll make $1,000. Well, here on a leap, if the stock price goes up $10, you would go from here to here, and you paid 7, and now it's going for, let's just call it 14. Okay, let's just call it 14. We'll just go in between there. You've doubled your money. You've made 100% on your leap, where over here you'd make just a little over 50%. So that's how you make money on a leap, right? If the stock goes up, you make good money, right? So if you bought it for 7 and sold it for 16, sold it for 14, you doubled your money. You got 100% return on less capital because you only spent $700 instead of $1,939. I hope that makes sense. Now, it's not foolproof, right? If Tencent Music were to report earnings and crash, your leap is going to lose money, just like if you were holding the stock. So it's kind of the same thing. It's just you put up less capital buying a leap, and your percent on money returned could be greater than if you were to hold common shares. Now, this does have an expiration date. It won't expire worthless, but it could be worth a little bit less if you held it all the way to January 23. But my plan is to never hold them that long. I'm hoping, Tencent Music reports earnings here in the next couple weeks, whatever it is, and they have a pop, and I get out of these leaps with maybe a 50-60% return or more. We'll see. But those are leaps. You can as well turn these into PMCCs. Like I said, got videos on that. That's just selling a covered call against them and collecting money. But in these 2 cases with VTRS and Tencent Music, I am not doing that. I'm just holding for gains, kind of similar to holding long stock. So I hope that helped. You guys have a great day. If you have any questions, comments, concerns, leave them down below. Check out that last week's video. Saturday is my Retire with Less video. I really like that series, and I think you would too. So you guys have a great rest of your week. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.